Good morning, everybody. It is July 7th, 2020. Kirk Spano, Investment Trends 2020 YouTube channel, Fundamental Trends, investing website, margin of safety investing over at Seeking Alpha, and I own Blue Mound Asset Management for anybody who doesn't want to do it themselves. Hope everybody had a great weekend. Ended up getting out to the pool a couple of times myself. And it's just too darn hot out here in Wisconsin all of a sudden. 4 months ago it was cold, and now it's in the 90s with 90-something% humidity, so it's like Miami. And, enjoying the air conditioning all of a sudden. Seems like more and more we're inside. And between coronavirus and extreme weather and everything else, it'd be nice to get back outside just a little bit more. In any case, got some stocks for you today. A new streamlined webinar process that I've been talking about for a couple of months that we're starting to do now here after the 4th of July and for Independence Day weekend. Each Tuesday, I'm putting out the stocks of the week. And this week, it's Sunrun, Dominion, Berkshire Hathaway, Nutrien, and Costco. And in fact, everything has sort of a theme that runs through Berkshire Hathaway. Interestingly, I think that all of these companies could be doing pretty significant business with Berkshire or even being acquired by Berkshire in the next several years. Berkshire, of course, has the railroads, does a lot of business with Nutrien. They are getting big into alternative energy, Sunrun. They just bought natural gas pipelines from Dominion, and they are, of course, famously sitting on about $150 billion waiting to go on a shopping spree. And it sort of makes you wonder if anybody would have the ear of Chairman Powell, maybe it would be some of the billionaires who are sitting out there on all this cash that's been printed and saying, look, you don't have to keep pumping up the markets. We're going to buy because we have all this cash. And I think that's something that we ought to think about. In the Macro Monday piece, which I think I am retitling to focus on narratives and what people are missing in narratives and how these narratives could be reinterpreted. That'll be the Monday piece, which it's Tuesday right now, and I'll be finishing it today. It was a pretty good article, and then I just decided it was boring and like everybody else's, and I'm deciding to put a new spin on things. And it's going to focus on the narratives and why a lot of the narratives are wrong and how they are just backfilled into whatever the action is in the market. The stories that are out there, it's what you hear when the market's going up or when the market's going down. And I think a lot of times those stories don't matter. Those narratives are really just there to validate people's decision-making process, much like a lot of us use ideology or politics or religion or whatever else to validate, self-validate through some sort of rationalization of our existence in the universe. The stock market's a lot like that. A lot of times the stock market's just doing things because it's doing things, and there's not a lot of good reasons for it. We know that the stock market is dramatically overvalued. We know that most of the gains are concentrated in about 50 companies, and our job is to get into those 50 companies. And to the extent we've done it, great. To the extent that we've missed, let's get better. So let's start taking a look at some charts and some investment ideas. One of the things I said to Dividend Sleuth this week on his article, and if you haven't read his quarterly update, I think you probably should. Let's see here. Where is it? There it is. There's his update. If you hadn't read Dividend Sleuth's quarterly update, I think you should. especially if you're a dividend investor or close to retirement. Just read what he's saying about how he's managing his money, because that's really what he's sharing. And I think that you're probably going to get some good insights. I decided to comment on this article and got some interesting feedback. Some of it is good, some of it's bad. You have your trolls. But I talked about Berkshire, right? And I did that in an article as well. So if you go over to fundamental trends or margin of safety investing, I've got the quick piece on Berkshire Hathaway utilities and how I'm gonna be doing a pretty big ETF update tomorrow. So the ETF update you should be excited about. Really moving towards a relative strength approach, doing all the things we've been doing, but adding the relative strength so that folks who want to be more invested can be more invested. Just pick out the 5 or 6 or 7 best performing sectors and follow the gains. Now that'll require you to be active. It'll require that you are paying attention. These are not set it and forget it things. Every several months, sometimes weeks, but generally several months, you're going to have to adjust your asset allocation for changes in cyclical trends. But I'll explain more of that tomorrow. So let's talk about Berkshire Hathaway. So Berkshire Hathaway bought the, let's see here, I know what I want to do. Pipeline assets, natural gas pipeline assets of Dominion Resources. And Dominion Resources is one of the utilities that have been on our list. We haven't really jumped in because I thought it was a little bit overvalued, and I thought they had some cleanup to do with their asset base. And I really did think that they might sell their liquefied natural gas plant. And it turns out that the deal with Berkshire, Dominion basically sold all of their natural gas pipelines and a 40% share in the liquefied natural gas facility, which I think that Berkshire Hathaway ultimately buys the rest of. So you take a look at the deal, and Dominion becomes more of a pure play on utilities, just a utility pure play. So if you are a dividend investor, down here at around $70 a share is where Dominion gets real attractive. So on this deal where they sold, it really is a retrenchment on their part to clean up their balance sheet, because they recognize that probably liquefied natural gas is going to be more specialized and building infrastructure is going to be difficult in managing it. They just wanted to focus their business. So they came all the way down here to the bottom of this range, and this is where I had the buy range. And if you're just going to try to trade a utility, which I don't know why you'd bother, I think you probably can buy it right in here because there's this big gap down here. And this is ultimately where I'd want to buy it, though, if I'm a dividend investor, because then you're getting a good dividend, you're getting a big margin of safety. So down around 70, I think is where you can build a real position. Up here at 73, 74, you're basically looking for a bit of a rebound bounce. But I think that ultimately you get the wave up, maybe to 77-ish. There's a confluence there, and then back down here towards 70. So right around 70, the numbers make sense for Dominion as far as the size of the dividend, the safety that you're getting, the fact that it's a regulated utility on the East Coast. They're transitioning into alternative energy, and I think you're going to see them, become a big deal. They're already one of the biggest utilities, but I think you're going to see them become more of a profit-centered company down the road, because as their expenses come down, obviously what they're charging you and me won't come down as fast, and their expenses are in fact coming down. So as they clean up their balance sheet and they kick out the dividend, if you're a dividend investor, right, if that's your primary goal is stability of principal with a little bit of growth and a good dividend, At around $70 a share, Dominion becomes worthwhile. If you are a growth investor, you're not going to prioritize this as one of your top 30 companies. And again, I was talking to Dividend Sleuth about that, is ultimately nobody can keep track of more than about 30 companies. I don't care who you are. So unless you're using artificial intelligence, and I'm using two to keep track of things, it's just impossible to do. So when I was trying to do this all in my head a few years ago, after 30, 40 companies, you get lost. So you build your asset allocation using ETFs, and then you add anywhere from about a dozen to about 30 stocks to give you an overweight in the things that you think are the best. Because why on earth would you invest in any stock and accept that individual company risk, that single stock risk, if you didn't think there was something extra to that company, right? I wrote an article about Enphase. I actually wrote it last Thursday. I just got it published. And, you go here, and I wrote an article about why I'm selling Enphase. And, I get a lot of hate on here because I'm a seller. Oh my God, you're a seller. And, people want to say it's a safe bet, but the fact is that Enphase is getting a lot of competition now. So they went through their hyper growth, right? Enphase went up, how much? 1,000% from 5 to 50, and they were all the way up to 70 at one point. So I think that you have to consider that even if the short seller is wrong about fraud here or accounting shenanigans, the reality is that Enphase already had its big growth period, right? If you can, how do I get this to pop out? Take a look at Enphase on a 5-year chart. I mean, that's pretty parabolic, right? And that's straight up, big correction, straight up, big correction, straight up, not as big correction, but I think you could see it all the way back down here again, in this 30-something range. And why is that? It's because when you look at the solar sector, which we're getting into in a couple of minutes with another company as well, is you start saying to yourself, okay, who's going to generate the revenue? And inverters are a great business. I like SolarEdge. I like Enphase. But they're getting competition now. They were a duopoly, and that duopoly is slowly eroding, which means there will be margin pressures. So even though the sector is going to grow incredibly fast, unless you're going to build your own solar ETF, right, your own little dozen stock solar portfolio to take the place of TAN, which is the solar ETF, I don't think you need to own Enphase right now, right? Do I think there's accounting shenanigans? I don't know. I don't know. There's been some weird things that have happened over at Enphase, but they're all explainable. So you don't really know what's what. And ultimately, if we're looking for a margin of safety, right? If we don't want to be speculative, if you don't know, get away. And here's the other thing. Since the last earnings report has nothing to do with the short seller report. Since the last earnings report, the stock has underperformed. Relative performance, relative strength is where we need to have a lot of our focus. We want the stocks that are going up. Will Rogers was asked one time, what stocks do you invest in? He said, the ones that go up. Seems kind of simple, right? So ultimately, with the ETF models and with the stocks, we're applying another layer here in the future. And I've done it in the past, and it didn't really matter when valuations mattered. But valuations haven't mattered now for a while, which is weird. In the same way that I decided that I just didn't want to deal with oil stocks anymore because the long-term trend is down. I'm not going to argue with the market if it's going to tell me that valuations don't matter, and that is very counterintuitive as an investor, that valuations wouldn't matter. But it is what it is. You have a lot of speculators in the market. Sometimes you just have to run with the herd and know that the herd can change directions quickly, as it seems to be doing on Enphase. In the last 2 months with Enphase, the stock has not beaten its industry benchmark or the S&P 500. So that is important. If you're not going to get value, true value, then you have to have momentum on your side. And ideally, you want value where momentum is just starting. And that's really hard to find. So where we can find the pivots on value stocks that have growth and price momentum is starting, hey, we're hitting home runs there, but those are incredibly hard to find. So my screening process looks for those, and that is really something that I think is evident in the stocks that we're going to cover today. So let's go back to Berkshire Hathaway. So Berkshire Hathaway has been trending sideways, had a correction. It's actually down for the year. And if you take a look, you can see that's been consolidating right in here. And this area here seems to be a spot where it would start to break out. Now, it doesn't mean that it's going to go through that line now, that 185-ish area. Could pull back down into the 170s again before it rallies up. And here's why it's going to rally up. Whenever Berkshire decides that it's time for them to invest $150 billion, I wouldn't expect that they're going to invest in things that won't grow, right? They're looking for cash flow, and they're looking for growth. That's why they have the biggest position in the world in Apple and a very large position in Amazon. So the idea that Buffett doesn't invest in tech companies isn't true anymore, because Combs and I forget the other guy's name, are in fact investing in tech companies now. So I would expect that Berkshire Hathaway on the next market correction is going to deploy a lot of money into technology and other businesses that have organic growth. And at 90 years old, it's clear that Buffett is throwing in the towel a little bit on that with the Apple position and the Amazon position. I would think that you would see Berkshire Hathaway probably buy some Microsoft or Google or maybe some of the fintech. And why the fintech? Because he has a big position in banks. And he can hedge his bets by buying the fintech, right? And he might even get to see some of his banks buy the fintech or the fintech buy the banks. So I think between fintech and technology in general and alternative energy, and the natural gas pipelines, which I just gave that big interview about natural gas pipelines, I think he's seeing a lot of things that are going to be worthwhile in the future. And, when I talked about the natural gas pipelines in the Seeking Alpha article, I said, the reason why you buy a Kinder Morgan or maybe a Williams is because natural gas is something that's going to have sustained use for decades, right? So even though we're weaning ourselves off of oil already, and it's a long process, it'll take 20, 30 years before oil is down to half of what we're using. The natural gas is replacing about 1/3 of the closed coal plants. And as oil production is lower, that means there's less affiliated natural gas that comes from oil wells. So the natural gas pipelines are going to do pretty well. Why? Because even though the natural gas companies probably don't have a lot of cash to throw off, they're going to stay in business long enough and do well enough to pay their bills. One of their bills is paying the pipeline companies. That's why Buffett bought the pipeline from Dominion. And I don't think that'll be the last pipeline he buys. You know, they're becoming a powerhouse in pipelines. I've told you that I think that Kinder Morgan is likely to sell at some point. It wouldn't surprise me to see Berkshire Hathaway end up wanting Kinder Morgan down the road, or Williams. I'm not sure how the pipelines overlap with Dominion, but we know that Richard Kinder is going to want to sell this at some point. So we'll see how that goes. I can't imagine he wouldn't take cash and Berkshire shares for Kinder Morgan at some point. So I want to own Berkshire Hathaway probably in the low 170s. So any correction, I'm probably buying Berkshire Hathaway because I know that they're going to deploy all that cash, and then they probably go on a pretty good rally and they break through this 230 range. And then once they break through the 230 range, whenever the next bull market occurs, you know, they could rally pretty high. They don't pay a dividend. I'm not sure if that's going to be true forever either. I do know that they'll probably buy back some shares here soon. You know, I don't think you see Berkshire go too low because they have all that cash. They can just buy back their own shares if they want. And he said that he would do that. So there's really not much downside to Berkshire right now. If they paid a 2% dividend, I think everybody in the world would buy it. And that might be coming too. Like I said, I mean, you might see dividends out of Berkshire strictly for them to attract more investors. Because if they were paying a 2% dividend, I think they'd beat the hell out of the market. So without the dividend, they're not getting dividend investors. If they threw a 2% dividend on here, I think this thing goes to the moon. I think you should get positioned for that because things that make sense eventually happen. And those dividends would be able to fund all those charities that Berkshire Hathaway is a part of, right? Berkshire Hathaway shares are within the Bill and Melinda Gates Foundation. And then all the other 5 or 6 foundations that Berkshire shares fund. So if the Berkshire shares were throwing off a dividend, they wouldn't have to sell the shares as often for money. So I actually do see a dividend from Berkshire in the future. Remember, they never bought back shares, and a couple of years ago, Buffett said, you know, maybe we'll buy back a few shares. Circumstances change. Buffett's not a real dogmatic guy. I think they add a dividend, and it might be by next year. So I think that you want to buy Berkshire right around 170-ish, you know, right down at this fib level, you know, low 170s is probably where you buy Berkshire. Dominion we already covered. It becomes a value with a good dividend down here around 70. Sunrun is a company. They just bought Vivint Solar. They are now the biggest residential solar play out there. 500,000 customers. And I think probably the best CEO among these companies, although, you know, Musk is a juggernaut, and the team at SunPower with the backing of Total, you know, is pretty amazing too. So I think, I say this in the article here, I think that Sunrun is positioning to pretty much lead the residential solar arena along with SunPower and Tesla. So if you wanted to build your own solar ETF, I mean, these are stocks that you could look to be adding. I've been buying SunPower pretty much nonstop all year. Sunrun I have recently added back when it was in the teens. And then Tesla, you know, we talked about it at 250. We held it till the 400s, and the damn thing went to 1,000. Now, I will tell you, Tesla is not worth more than Toyota. They're just not. And will they legitimately be a $250 billion company in 10 years? Maybe. But does that mean that they chop around for 10 years with the stock price? I need Tesla to come way back to want to buy it. But it's a holding in ARK. ARK is one of our main funds. And SunPower is so cheap and has the backing of Total. Again, not much downside, but with potential to be a home run. So this basket you somehow want to be in. You can own the Invesco Solar ETF for sure, and that gives you exposure to Tesla. QQQ gives you exposure to Tesla. ARK gives you exposure to Tesla. So unless you want to become a very good Tesla trader, because it's certainly a stock that needs trading, I think you just get your exposure to Tesla through those funds. SunPower, on the other hand, is super cheap and is a stock that could go to 100 for sure. And it's under 10 bucks a share right now. Now it could stay under 10 bucks a share for a decade. But usually there's a hockey stick. And we know that the trend in solar is massive growth. So right now, about 3% of homes have solar, and probably 50% are going to have solar by 2040 to 2050 over the next 20, 30 years. And that's just existing homes. Existing homes are going to add solar, about half. New homes are almost all going to have solar within 5 years. It's already happening in California, and some other states are talking about it as well. But I actually think it's going to end up being a federal law that at least some solar has to be on every house. Maybe it just powers a backup battery or does the hot water, but I think there's going to be limitations on how much energy you can get from the grid if you're not supplying some of your own. To me, it's clear that those laws are coming. So Sunrun has a good power management system. Bright Box Battery is what it's called. And they have a partnership with Costco. The partnership with Costco cannot be understated. That could drive millions of installations for them. And their CEO, Lynn Jurek, you should read some articles about her. She's one of the best CEOs in America, I think. So she's got one of the fastest growing companies and one of the fastest growing industries. It looks like there's going to be 4 companies in this space. The other one, Sonova, is heavily in debt. They might get bought. Maybe that's a company Berkshire buys, right? They buy them out to get into the space, and they're able to issue shares and a little bit of cash and absorb the debt. So here you go. These are the companies you want to be in. Sunrun just spiked up on the buyout. They probably come back, and I don't think they see the bottom of this range again. But if something bad in the economy happens, they could get down into the middle teens again. I think right around 20, just on a retracement, you can buy Sunrun. So this gap up probably fills at some point, right? Fills at some point. And you'll want to buy right around 20, 21, right in there. I would have a hard time thinking that that's not a good buy spot. Could it break down through here on economics and correlations to the rest of the market? Certainly it could. So really there's 3 buy zones here, but I think you're smart enough to see this grouping, and this grouping of different support and resistance levels. Costco, I think, is also a potential buy. It's been consolidating sideways. And I think that if it comes all the way back down, you see this is a 0.618 fib level, and then so is this. So actually go up to here. Costco around 250, 260. I think you start saying, oh, that's a pretty good bargain for the amount of cash flow they throw off. And if you've really taken a look at how people shop today, you've got your Woodmans, you got your warehouse food stores, the great big spread out boxes seem to be the place where people are shopping. High ceilings, right? Good ventilation. I mean, this isn't just a coronavirus thing. This is, I think, the future of the world thing, right? Dr. Fauci came out and said, look, don't expect the vaccine to permanently vaccinate you. It's going to be temporary. So, you know, our behavior is probably going to change very long term. Maybe not as drastically as it is now, but I think there'll be more people taking precautions and just being more choosy about where they hang out. Do they want to be, you know, arm to arm, you know, shoulder to shoulder with people? They don't. They want to spread out spaces. They want some airflow. So I think that you can take a look at Costco in here. I've measured a couple of fib levels that seem to make sense. And I was reading another trader this morning when I got up. He said the most important lesson that he's learned, and you've heard me say this, is, and he's a good trader, is that you have to pay attention to the time frames of the charts you're using. So if you're a long-term investor, these weekly charts are pretty much what you're using, weekly and daily charts, right? Weekly charts to show you the box, and then you can switch to a daily chart when it gets down to the nitty-gritty of where exactly you're going to buy. Now, if you're a trader and you're looking for shorter term trades, yeah, that weekly chart mattered to you, but the daily chart is really what you're keying off of. Okay, let's see here. It's almost overbought on both of the daily measures. Money flow index is getting to be overbought. Relative strength index is even more overbought. Now, what do we know about money flow index or relative strength index? Well, relative strength index is about 65 here, but money flow index, well, also about 65. So this is a pretty true move, right? There's no divergence between volume weighted and not volume weighted. So this is a pretty true move. When RSI and MFI are equal, that doesn't much matter. There's a small skew about where overbought is and oversold is, but I don't know that it's worth paying that much attention to. The money flow from shaken money flow, right, which measures the momentum and the buying pressure starting to rise off of the bottom. So we could actually see Costco make a nice little run here to about 325 before it hits that, you know, look, it hit it right there, hit it right there, hit it right there, right? So Costco could get up to this 325 level again and then pull back. My expectation is that a lot of stocks are finishing up their rallies and will pull back soon. But I think down in here, again, if you're looking for kind of a more steady Eddie stock, I think that you can buy Costco. Right? Not a very big dividend yield, but I think it's going to grow. And as the stock price goes down, that dividend yield goes a little bit up. Somebody wrote an article here on Seeking Alpha about why dividend investing was better than capital gain investing. It was a very popular article for a little while. I'll tell you, none of the math actually supports that. I know the idea in people's head is that dividend investing wins, dividend investing wins, dividend investing wins. Not so true. In the last 20 years, because all of these companies have borrowed money to pay dividends and we've had an easy money policy, now people are chasing yield and bidding up a lot of stocks that don't deserve to be bid up because they don't have the underlying growth to support their dividend. When money gets a little bit harder, and it will, you're going to have big problems with some of these dividend payers. You know, the Fed has prevented dozens and dozens of S&P 500 bankruptcies so far by buying all those bonds. Ask yourself this question. What would have happened to those companies just on any recession if the Fed wasn't there to bail them out? Right? It's a good question. At some point, The amount of money that we're printing and the debt that we're running up matters. I don't know when that is. But we are at a higher debt level than we have been in a century as a percentage of the revenues that we generate and the GDP. And we know that the world is slow growth forever. So even if we print money or borrow money to rebuild the infrastructure, and it's a giant project, 3 trillion, 4 trillion, that's still debt or devaluation. And even if we do the Social Security lockbox like I think we should take all the Fed bonds, throw them into a Social Security lockbox, and let those run out there over 20 or 30 years and help to fund Social Security. And instead of letting the Fed buy stocks, which is not legal right now, so the idiot that wrote the article on Seeking Alpha about it's imminent is fucking moron. It's not legal for the Fed to buy stocks. There would have to be an act of Congress. And I don't see Nancy Pelosi doing that before the election. Why would she help President Trump? Create an illusion. She's not going to do that. The other thing is the Democrats, who are probably going to be in power, and if you're reading JP Morgan or any other big banks, they're basically telling you that it's coming. The Democrats would rather fix Social Security than have the Fed with a giant balance sheet. The Fed is causing a lot of corruption of capitalism, and it's why capitalism only works for about 20% of the people nowadays. At some point, the wealth inequality issue and the safety issue and the healthcare issues all have to be dealt with, or these riots that we just saw are only the tip of the iceberg. So all those things are coming in the next decade. Is how do we fix the economy and make it more inclusive? Well, I believe that at least in the short run, that's probably choppy to bad for stocks. But in the long run, if Social Security starts buying stocks, gee whiz, so you could see a 20-year rally. So, just keep in mind that a lot of things change, and there's a lot of big problems out there. It's nice that he's jumping on the bandwagon with AT&T. That's another stock that we're in. You just have to pay attention to how the world changes and what makes sense. So, all right. So here's the Sunrun and Costco deal. And the last one we're going to cover today is Nutrien. Nutrien seems to have bottomed and is starting to grind its way higher. I told you a couple of months ago that the farmers were screwing the system. They're basically using the farm subsidies and the insurance programs to get their revenue. And one of the ways they were saving money was to not fertilize their fields. So their fields are going to be pretty spent by next year. And Nutrien, right, former Potash Corp, and Agrium, and Mosaic, all of the fertilizer companies have kind of pulled back on production. So you're going to have a pretty tight fertilizer market by next spring. And I don't know that we can get this stock any cheaper. So they have a good dividend, right? If you take a look at Nutrien, 5.5% dividend yield. I don't know that you can do much better than 5.5% on a company that has almost no downside. Now, the Armageddon scenario for them is probably around 20 bucks a share, right? They got down to about 28. I just can't see it happening. Could they retest? Absolutely. But from 32 to 28, I think you're splitting hairs. I think that you can sell puts on this one regularly until it's put to you. But the dividend's big and fat. So you want to have it put to you sooner than later. So I'd probably be looking at like an August put at about $32, $33, $34 a share right in this area, because you want it to get put to you and you just want to get a little something extra, right? An extra buck or something. So I think Nutrien is building a nice base. It's an uptrend, and I would expect this one to rally all the way into the 40s probably next year or the year after. And I think it's got breakout potential way up here. And Potash Corp a long time ago was way up here. So this stock, I think, is coiling. I mean, just look at, recognize that pattern. That is a stock that wants to break out. And I think in the next year or so it will. So if you take a look at relative strength index, it's got a long way to go up. Take a look at the money flow, 56. Pulled back here recently. But the money flow is way higher than the relative strength index. What do we know about that? Right? What do we know about that? Money flow is volume weighted. So if money flow is way up here, it's going to pull relative strength up. Right? Shaken money flow has been moving in the right direction. So, and then your MACD, right? Starting to move in the right direction. You know, you could see these guys really rally. I mean, this is set up for a monster rally. You know, the first leg will be into the 40s. But once it breaks through on bigger sales for fertilizer in a tighter and higher priced market, I mean, you can see them just dropping all kinds of cash to the bottom line. So, you know, we'll see. But I like fertilizer. There's not a lot of risk in it compared to other stocks. Lower beta, pays a fat dividend, and you know, it's a tightening market, and we know that the farmers are going to have to fertilize at some point. I mean, they can't skip their fertilizer every year like they did this year. So there you go. I think that Nutrien is basically a buy right now. I think that Berkshire Hathaway is basically a buy right now. Dominion could be down around 70, and it might get there soon. You just want to see them, you know, come back down and fill that gap. 20-ish on Sunrun. This is another stock to go way over 100. And Costco, if you want a staple, I think that Costco down in here becomes pretty worthwhile. Dividend gets over 1% with a lower price. And it wouldn't surprise me to see Buffett take a pretty big stake in Costco. It just seems like a Buffett type of company. So we'll see. I think Costco still has a lot of room to expand. I think clearly they're kicking the pants out of Sam's. So I think that Costco, you know, we just got one 4 or 5 years ago by us, and there could definitely be 3 or 4 more in the Milwaukee area. So they probably can double their footprint in the next decade. That's a lot more revenue. And the fact that they put solar on their roofs makes them virtual power plants. What is a virtual power plant? A virtual power plant is when a solar company like Sunrun puts solar on top of commercial or residential buildings, connects them, and then feeds that energy into the grid when the grid needs it. So they've been doing this in New York quite a bit, the virtual power plants. And I think that there's more and more of that coming. Big box stores are the perfect places to put a virtual power plant. Not only can they provide their own power, but they can throw off power to the grid or to other buildings in the other commercial buildings in the area. Tall buildings in particular, it's difficult for them to put solar on. But the box buildings, right, they can do solar. So consider how the energy grid is going to change, and that we're not just looking to Costco for our toilet paper, but Costco and Kohl's and Walmart, the big box stores, are basically going to become energy generators. And that's pretty lucrative for them, right? That's why the utilities that you get into need to have some sort of transmission, right? They have to have something valuable besides just producing energy, because energy is going to be plentiful, I think, forever. I don't think we're ever going to have an energy shortage again. You know, even as we add millions and millions of EVs, it's not going to matter. There's just going to be so much electricity from the sun, it's going to be unbelievable. So how fast will this happen? Yeah, it's going to take 10 to 20 years, but it's going to happen. So you want to be on the side of those big trends. So there you go. There's your 5 stocks for this week. I think Nutrien and Berkshire, you should be looking to sell puts on pretty much right now. Or if you want to start nibbling and then nibble more if it goes lower, if they go lower, that's great. All right, I'm going to stop the recording right now and take a couple of questions.